Oh, wait, go start over.
You sure you see the timer?
Yes, now it's on.
Okay. Good morning and welcome to the Invest with the Best Project 2 portfolio. Today we're kind of going to go over and discuss with you how to develop a diversified portfolio. So what we did was our first step to building a portfolio is, of course, you choose your companies. What we did was we initially had 22 companies. What we looked at everything and whittled it down to 6 companies. What I did was, because for me it's easier to kind of actually see examples rather than somebody just talking to me, I went ahead and I made us an initial $10,000 investment off of Yahoo Finance. So I kind of already built a portfolio for us so we can actually see examples of how things are moving. Of my factor and how I came up with the 6 companies, we'll kind of go through the 7 components that I looked at and compared. Of the 7, that was sustainability, revenue, earnings per share, your ROE, your forecast, your earnings growth, and what we call the PEG ratio, which we'll kind of go through at the end and talk about. So, and again, like the revenue, the EPS, the ROE, the forecast is what I would like to call, it comes from the NASDAQ 12. And again, we'll go through that in the end. And as always, with building a portfolio, your main goal is to make some money. So of the 6 companies, the companies that I chose was the CF Industry Holdings, Chicago Bridge, Albemarle, Pool Corp, Mosaic, 3M, and then with my change left, I went ahead and just bought a 3-month T-bill. We'll kind of go through, what each company does. CF is in the agricultural chemicals, and they manufacture and distribute nitrogen and phosphate fertilizer. CBI produces and they design engineering, construction, fabrication, maintenance, and environmental services. Albemarle, who's in the specialty chemicals, they produce specialty and fine chemicals. The company's chemicals are usually used as additives or intermediate for plastic, polymers, cleaning products, etc. Then you have Pool Corp, who they are like a wholesale distributor of pool supplies, equipments, and other related leisure products. Mosaic Corporation, they are a part of, again, they're kind of like CF Industries. They're in the agricultural chemicals, but they produce and distribute crop nutrients to the agricultural communities in North America and other companies. Then you have our 3M company. They're like a container and packaging manufacturing company, and they conduct operations in electronics, telecommunications, industrial, consumer, and office products. So now that we've decided what 6 companies out of the 22, I'll go ahead and show you how all this relates and how you can possibly make some money in investing. So what I did again, and I will show you here, is the percentage of my $10,000. And over here to the right, you'll kind of see actually how I started the portfolio. So of the $10,000, I went ahead and spent like 20% of our money on the Albemarle, CBI, 3M Corporation, and Pool Corp. So then I went ahead and I took 10% of our money and I bought some CBI shares, some CF shares, and Mosaic. Then with whatever money that I had left, I went ahead and I purchased again like 4 shares in a treasury bill. So from here you can see our total, and our market value is worth $9,973.28. So part of our first thing and our first criteria that you want to look at is sustainability. Sustainability is pretty much how companies plan on in the future making their profit margins. What are they doing to make sure that they're going to be around in the future? So the future plans for CF Industry is that the demand for food grains is increasing. The global demand for fertilizer is expected to increase from 134 billion to 223 billion in 2015. So CF Industries plans on expanding their production of nitrogen fertilizer by 1.2 million tons in 2013 and 4.5 million tons in 2016. CBI, the other way, they were just awarded the Freeport LNG expansion terminal project. That estimates to break in $3.4 billion in revenues for the project. Albemarle, they've been rated as a buy by 5 analyst companies. Part of the thing that they were looking at is that its PE ratio of 20.5 is above the S&P 500 PE ratio, of which is just 17.7%. Their shares are up 3.3 year to date, and again, that comes from the Streetwire as of June 10th, 2013. Pool Corp, they've been identified as having a large market cap than the smaller end of the S&P 500, which was the Apollo Group, which was at 2.23. One of the reasons why investors should keep an eye on the market capitalization, it gives you a true comparison of the value attributed by the stock market to the company's stock. Then you're comparing apples to apples. It's also important because it places a company in the terms of its size tiers in relations to the peers. The Mosaic, how it plans to be around in the future and how it plans to amp up its revenue is that it plans to take over Cargill. So when it takes over Cargill, it will increase its production of potash by 50% a year to 16.5 million a ton by 2021. So again, it's reported that a 37% year-over-year increase in sales for potash segment, which should amount to $758 million in the third quarter of 2013. And lastly, our last company we're going to look at is 3M's Optical System Division is finally bringing their QDEF color enhancement technology, which is going to be placed in LCD displays. So that's been picked up by Apple and put in their new iOS 7 operating system. So again, the future plans are pretty much how a company will be sustainable in the future. You want to make sure that whatever company you invest in, again, you're investing for long term, so you want to make sure your company is around for long term. Our next thing, and kind of the other thing that we went through, is when you want to diversify, you have to make sure, look at the correlation factor of all of your securities. The correlation factor is basically the measure of how your companies move with the stock market. You don't want both your companies moving in the same direction, because if the stock market crashes, both your companies then stocks are going to crash, or you'll lose some money. So best if what you're looking at is a correlation factor anywhere between 1 to the correlations go from +1 to a -1. So you want your correlation factors to be closer in on the negative factor. 1, if your correlation is a 1, that means that they're moving in the same exact direction. So again, I kind of gave you an example of how it runs. So if you look over here, you can see your CF Industry and Pool. Their correlation is 0.203. So if you look over here, you can actually see a perfect example. On this particular day, our CF stock actually decreased, but you had an increase in your Pool's stock. So another perfect example is if you go over here and you look at Pool and Mosaic. Again, their correlation factor was a 0.26. So again, on this particular day, while your Mosaic stock went down, your Pool stock did go up. So you kind of want to look and see. So out of our 7, we actually had Albemarle, CBI, 3M, and Pool Corp. All stocks actually gained in price, and kind of what went down was our CF and our Mosaic. So that's a good example of how your correlation really work together. Our next thing is we're going to just kind of quickly go over the performance and the efficiency frontier. And what the efficiency frontier is actually where your company stands as far as your risk versus your return. So you want your stock to be on your efficiency frontier. If it's not on, you're going to try and move it as close to the efficiency frontier as you possibly can. So again, okay, so we discussed part of our criteria, and kind of what I threw out to you before was your NASDAQ test. which I like to use. The NASDAQ is actually came up, it was actually 12 steps, but since this is our first, and I don't want to overwhelm you too much today with kind of explaining things, we're just going to kind of go through what I call the NASDAQ half dozen questions and just go through 6. So of that is your criteria. Is your revenue increasing? Is your earnings per share increasing? Is your revenue, your return on equity increasing? Is your earnings forecast increasing? Is the earnings growth rate higher than 8%? Is the PEG ratio lower than 1%? So we'll start here and look at, is your revenue increasing? Well, you can see here from 2013 to 2011, CBI, Pool, and 3M corporations have all increased. While you have seen a slight decline in CF, Albemarle, and Mosaic, again, let's go back to how your companies are sustainable. They all have plans on expanding their products. So for 2014, their earnings growth rate should increase. The next one is we're going to look at your earnings per share. Your earnings per share represents the portion of a company's profit allocated to each outstanding share of common stock. The net income for a period divided by the total number of shares outstanding. So again, is it increasing? And you can see, yes, CF has increased from 5.5 to 6.47 in 2013. Pools is also, well, actually, Pools kind of went down a little bit from 2012 to 2013, but if you can see the huge increase, it was actually at a negative 0.1 in 2011, but has increased to a 0.7 already in 2013. So, and again, we're looking at long term. So while they have kind of fluctuated a little, I don't see any real future red signs. Because again, if you look, remember, CBI was just awarded the Freeport expansion, which that in the next coming years, they could have a 3 to 4 billion increase in their revenues. So our next slide, or our next criteria we're going to look at, is your return on equity. And for my companies, I went ahead and I tried to pick companies, well, actually when I did it, as you can see, all of the companies, I did a benchmarking of higher than 17% for the past 3 years. And you can see how high CF's return on equity was 35%, which each one of them has increased from 2012 to, and this was the comparison, 2012, 2011 to 2010. Our next one is your forecast, or is your yearly earnings increasing? And this is coming from other analysts.
What's going on with the color of this thing?
That's all right. You just keep doing. So your forecast, is the yearly earnings increasing? Well, that comes again from other analysts. So, you know, while it's important to look at the stock's past earnings reports, it's also important to look at the future earnings forecast. So is your EPS increasing? And these are for years 2013, 2014 to 2015. And you can see how high each one of them are going. Each one are experience some sort of an increase. Then we're going to kind of go through our next one is your earnings growth. What I wanted to do, and you know, another sign of a strong company is if they have a 3-year growth earnings. And so you might ask, what is your earnings growth? This is a number that gives you an idea of how much the analysts believe earnings are going to grow per year for the next 5 years. It's basically a measure of your year-on-year earnings per share growth from the prior fiscal year. So while these were pretty negative for CF, Pool, and Mosaic, they are expected to increase. And again, because we're going over long term, I'm looking at the long term between the 3 years, and are my earnings growth expected to be higher than 7%? And if you look, I mean, this at one time, this for 2013 is in the negative, but look how high they're expecting, like a 37% return by 2015. So again, stay focused on your long term. This is long-term sustainability. Our next slide that we're going to look at in our last criteria is your PEG ratio. And your PEG ratio, as an investor, you should look for the companies with good growth prospects selling at attractive prices. What the PEG ratio identifies such stocks. It's pretty much your price earnings ratio divided by the growth rate, forecasted growth rate, and forecasted earnings over a 12-month period. So, and how do you rate this? It's the lower the PEG, the better. So what that translates into, you're actually paying less for future growth. So your earnings, and these all again are your PEG ratios as of 2014. So mine are on a scale from 0 to 3. So all these are pretty much on the low end of the PEG, which means if you go ahead and buy these stocks, what you're doing is you're paying less for your future earnings. So, okay, and if you want to look, how is investing in the best portfolio performing? Well, as of June 28th, our stocks are up. Well, we've made $67.88. So we were up 0.68% to date. So again, this is based on long-term growth. So in conclusion, let's go back over here. So in conclusion, when you're looking for stocks and you're trying to invest and have a diversified portfolio, you want to look for companies with sustainability. And that is because you're going long term. You want to make sure that you're choosing companies and choosing stocks that are going to be around in the future, at least 4 or 5 years out. You want to look for companies with high profit margins. Profit margins higher than the industry averages. I just went ahead and I took a benchmarking. I went ahead and I picked companies with return on equities higher than 17%. You also want to kind of throw in there low leverage. And while we didn't kind of go through a slide on that today, I did look at the low leverages through the companies, when I was analyzing them. You want to go for a low or a negative correlation. That shows that the two securities are moving in the opposite direction. You also need a commitment to your long-term gain. Another thing that we kind of really didn't touch on, but I did look at and was a part of my factoring when I whittled my companies from 22 to 6 was your beta. And I went for a beta which was less than 2. So the beta is just how risky your company moves, independently with the stock market. And lastly, did your companies pass the NASDAQ half dozen? Thank you, and I hope this helps. Hit the red button.